Yeah, we'll start dealing with our third subject, corporate finance, wherein, okay, from an exam standpoint, it carries an 8% weightage. So typically around 20 questions is what, or 18 questions is what you can typically expect. 9 in the morning, 9 in the afternoon, and consists of 6 chapters. But all these six need to be looked at from the perspective of what does a typical finance department in a company do, in a manufacturing company or in any of the companies, the typical roles that are performed by the finance department in the company, apart from the investments angle, as a part of the business, what are the various roles that they are performing. So that's where we look at capital budgeting here, which is more of how do I evaluate long term projects, right? Where to invest, how much to invest for a project, which projects to take up, how do I evaluate which projects need to be taken up and which projects need to be ignored. That is what is one aspect. The second chapter deals with cost of capital, which is more to do with how do I raise finances, and what would be the cost that would incur the company for paying for those finances. That's the cost of capital kind of a chapter. Then we deal with usage of leverage. We have discussed to some extent the leverage borrowings and kind of stuff. So there is a small chapter on leverage. There is one associated with the dividend policies of the company, dividend and share repurchasing policies of the company. And then we also deal with what is called as working capital management, which is short term borrowings and lendings and short term capital management process. And finally, there is a chapter on corporate governance, which is more to do with how do I address the shareholders, right? Because how do I ensure that my shareholders are happy? What are the various things that I need to make sure or ensure that the shareholders are adequately informed about the company and all. So these are the 6 chapters which we are going to deal with as a part of this subject. So the first of them being the capital budgeting process. Whenever we use the word capital budgeting, as the word itself means, capital is always long term. Capital is a word generally associated with long term. So we are talking about capital budgeting means evaluating long term projects and setting aside a budget for them, right? Because that's a very huge activity for a company, right? They have to evaluate long term projects and allocate some budget against them. So it could cost few millions of dollars, and some of them are like let's say they could consider expanding to a new geography. That's a mega decision to be taken, and it involves a huge capital, right? And the benefits of it will be for very long period. Probably I invest some money today by moving on to a new location. Let's say today there is a requirement. I need to invest a huge amount to form a new state capital, which may fetch returns over a considerably long period of time. Now, how much should I invest and in which location should I invest? How much will it fetch to me over what period? That is a capital budgeting decision. A huge investment being made either for a geographic expansion or a new product line expansion, right? Or it could even involve buying a machinery, big machines or equipment. I make a one-time purchase, but it will give me benefit over a long period. Wherever a decision has to be taken on those counts, even purchasing a house, it's a capital budgeting decision, right? I invest something today, but the returns for it will come in a very long run or for a long period. So wherever we are talking of the benefits coming for more than 1 year, beyond the current financial year, we are all treating all those decisions as capital budgeting decisions itself. And they have a very important job of the finance manager of the company, because one huge investment is required. It is a very significant investment compared to the total worth of the company. Even if I have to purchase a house, probably the amount I am spending is very huge compared to my total worth, total wealth which I have. So it's a huge decision that is generally taken in terms of capital budgeting decisions, and the benefits don't come very immediately. So if I have made a wrong decision, it may impact the total profitability of the firm, and it may even result in the firm going into doldrums altogether. So that's the reason capital budgeting decisions are very important. And even the same logics, how we evaluate a capital budgeting decision, the same logic is used even for the stocks evaluations or M&A evaluations. Every evaluation uses the same concept. Again, your NPV, again, your IRR will come up in all these decisions itself. And if at all you have taken a good decision in terms of capital budgeting within your organization, it is sure to increase the share price of the company. A wrong one will result in a big failure in the share price of the company also. Big drop in the share price of the company also. So that's the reason it's a very important aspect to look at the evaluations of the various capital budgeting decisions. So it starts with idea generation process in terms of where I should invest, or in terms of where I should invest, right? Basically geographic expansions, product expansions. I get ideas from various sources, and each of these ideas I evaluate them based on cost benefit analysis. How much I have to incur today, and how much benefits I can expect, how much profits I can expect out of these investments in the future. I have to do an evaluation of, out of all these projects that are available, which of the ones are highly profitable for me. And based on that, I will do a budget allocation and keep monitoring. Because one way, if I monitor, at least if I want to exit within a couple of years, I may start planning out. Let's say if this house purchase decision was a wrong decision, before everything is lost, probably I may react quickly and I may sell it off at slightly lesser price rather than selling it off at a very much lower down kind of a price. So though it's a costly process, at least the continuous monitoring will help me in terms of improvement also to some extent, right? So some of these things go under the capital budgeting decisions. Replacing a equipment. But in that replacing the equipment, there are two scenarios. One, I am replacing it for the continuation of the business. Let's say if this is gone, if this one machine is lost, if I don't purchase a new one, then probably I will lose my business. So replacement for business maintenance, business continuity, in that case, getting an approval is very easy, because your business won't run without it. But if there is a replacement project for cost reduction, I want to go for a very heavy, powerful machine which can do some more benefits, or it can reduce my overall costs. In that case, probably, though it is good, sometimes the decision may not come so easily. The approval may not come so easily. If this is already existing and it is serving the purpose, why do you want a super powerful machine? So there you have to give a very good cost benefit analysis. Okay, even if I spend a few millions on this new machine, but over a period it is going to reduce my cost by this much, this much, this much. A kind of a big picture is what has to be projected, and after that also you don't know whether the approval will come or not. If a replacement is done for a business continuity, we are sure that it will be accepted. But if it is for a cost reduction or something, a very detailed analysis is very much required. Otherwise, I can talk about expansion projects. Even that, those are a part of capital budgeting decisions. Geographic expansion, product line expansion. They are complex, but they need to be evaluated. And apart from that, we also have some mandatory projects. Like the government says, if you have to construct these many apartments here, probably you have to lay a road also. They are mandatory, which may not be profitable at all for the company. Right? Probably if you are setting up this industry in this location, you have to plant trees for 5 kilometers. So these kind of mandatory things will be there as a part of some of the projects. As per legal or government regulations or whatever it is, from environmental safety perspective or whatever, there could be some kind of mandatory projects. In those projects, you may not have any revenue out of them. So it's a cost. To what extent you can reduce your cost is the only thing you can think of, but you may not think of getting a profitability in those kind of projects. But in some cases, they may accompany other revenue generating projects. If you do this only, we'll give you the contract for that. Right? So those kind of things you have to plan out. How much would it cost you altogether? And if at all there is a loss, what is the size of the loss? So that if you want to recover in some other projects, how much should you quote for them? Right? And there could be other projects like R&D projects, which will go on and on and on, maybe fetching not too much, or sometimes they may be very flop oriented also. Right? You may do a research for 2 years, but suddenly realize that this cannot be translated into any product. So even I have to do a budgeting for those R&D projects. There could be some pet projects of the senior management, right? Though the manager is somehow fancified that I will go for this kind of a project. Whether it is feasible or not, or whether we have the relevant capacity or not, he may try to spend extra amounts because it is his pet project. So in those cases also, doing a budgeting, allocating the capital, evaluating the worthiness of the project, all these things have to be evaluated, because at the end the company has to function for shareholders. Company should not function for managers. Right? That's a very common funda everywhere. Manager is being compensated with a salary every month, but he does not have any hold on the company. He is working for someone else. So as per that person's decision, that person is nothing but shareholder. As per that person's decision, the manager should typically act. So every task, every activity which the company is taking up, we really need to see to what extent is it going to add value to the shareholder. If it is not adding much of a value to the shareholder, probably from a finance standpoint, that project cannot be taken up. Right? So that's where we need to have a couple of mechanisms to evaluate those capital projects and decide how much has to be invested in each of those projects. Now, whenever we do any kind of calculations with respect to capital budgeting, some of these principles need to be kept in mind. The first thing, incremental after tax cash flows only need to be considered. Now, 3 words which are very important for me here: cash flows. So I am not bothered about the profit. I am bothered about the cash flow. Of course, in financial reporting and analysis, we'll discuss even more in detail what is the difference between profit and cash flow. But for the simple time being, I want the real cash. How much really, not the accounting books, not the profit in the accounting books, but I want what is the real cash which I can generate in each of the years. So the whole, probably one differentiation between the accounting job and the finance job is also this. Accountant's job, the key role is what is the profit of the company, the key output. Whereas the finance guy does not even bother about the profit of the company. He bothers about the cash. What is the real cash? Right? So that's where for all our evaluation mechanisms, we use a concept called discounted cash flow. We are more bothered about cash flow, not the accounting book profit. Right? So first thing we have to consider is we always look at the cash flows after tax. Right? Because anyhow, if I'm considering before tax, some portion I have to pay to the government only. It's nowhere my benefit. So my benefit, whatever I am getting,